what we're doing today is just focusing on the quantitative analysis side. The idea that I present today to you is just that. It's just one technical idea. It's the quant analysis which is the most important. So I'm using Optex Bands. I've talked about Optex Bands before. You can see a webinar that I did for the CMT on that at optima.com/Optex. It is a mean reverting idea. So you see that blue band at the bottom? Whenever that ratio line dips into that blue band, then we get a signal. And it has a really good hit rate of a good mean reverting signal. So that's just the idea. As I said, I don't want to spend any more time on that, but it could be any idea that we're using. So when I did this, so I created this tool with Carsten Dahlberg back in 2016. And when we did this tool, we had some brilliant results. You know, we're very, very careful not to overfit and go data mining or anything like that. We're very careful to make sure that there was a sound technical principle behind the signals we were creating and that we were getting good results. And we had this idea that one way of knowing whether we had a good signal was to look at a flat market. So we looked at the market from 2001, 2009. You can see that red line on that chart there. It ends up flat. So between October 01, October 09, the S&P 500 basically ended where it started. And so we figured if we had good results in that period, then we knew we were onto something and we could almost say that there was alpha there. So you can see the results we had in that period. This is actually a back test. In a moment, we're going to talk more about signal tests. But this is a back test. We would buy on that Optex signal. We would sell on change of trend. And we had 21%, nearly 22% annualized returns over that period, while the index was only getting 1.3%. So we thought this is phenomenal. You know, we've cracked something really, really good. And so then obviously following that for the next couple of years didn't lead to such great results. So here's the period for 2012 to 2022 as an example. And you can see that our annual returns dropped to 8.8%, while the annual returns of the index were 11.3%. So definitely not a great result anymore. And what was even worse was that if you were to ask me back then, when does this signal work the best? I would have said when the stock market's going up. It's a mean reverting Dow theory, you know, trade with the primary trend. A mean reversion is a good secondary trend action. You know, that's going to be best. And I probably have stood up in front of groups when I've presented on this saying that. But the fact is, in what has essentially been a bull market, that wasn't what we saw. And so that bothered me no end. So I knew we hadn't overfitted the data. I knew Optex, you know, it was based on a thesis, a strong thesis, not hunting for an indicator that worked in a certain period of time. If I had developed Optex now, I probably would have abandoned it. I would have said, no, this idea is no good, throw it away, and let's go looking for something else. And so basically I sat on this for a couple of years because I didn't really know how to process this and what to do. And often what's been the case is I'll just let things sit in my mind, and then eventually you end up having a conversation with somebody and the penny drops. So for me, that happened once when I was, obviously, as Joel said, we teach the CMT curriculum. We have a forum where candidates can ask me questions about the material. And I was answering a question about the intermarket analysis. And as I was answering it, because it was about market performance in different phases of the intermarket cycle, and then suddenly, you know, the penny drops. And I'm thinking, hang on, maybe my strategy is actually working at different times of the intermarket cycle, and I need to now research that. Problem was that wasn't very easy to test at the time. So we've basically spent the last 3 years rebuilding a new quant engine so I could test all of this, which is annoying. But anyway, just to recap, for those that haven't done the CMT, the general theory, the Pring-Turner based theory here, is that typically we see bonds outperform and then roll over first. And then we have stocks rolling over, then we have commodities rolling over, and finally the dollar. And this is a generalized, idealized pattern that we see in the markets. So what I wanted to know was, can I define leadership? Can I say that there are, which is leading? Are equities leading? Are bonds leading? What about commodities? And so that's what we spent quite a bit of time working on. Now, what I've got here is the result of that work. So this is 30 years of data, and I'll blow this up in a moment. But blue is when stocks are leading the market. Now that means that stocks are outperforming all other asset classes. And then you've got green when bonds are the leader. The rust color there is when commodities, and then where it's white is when the dollar. And so you can see there some pretty interesting things jump out just by looking at leadership. So apart from the case in 1996, nearly every time when commodities becomes the leader is the top of the market. And so, that's a pretty much of a warning that if we ever see commodities outperforming everything else for an extended period, then there's a high probability that we've reached the end of whatever bull market we're in. Obviously, we know that bonds are outperforming right now. You can see the green at the end of the chart. Very interesting. And then dollar seems to outperform in our biggest crashes, our corrections in the market, which is very interesting as well.